of all this is something that is constantly evolving, right? Even the AMC guys, you're like, I don't even fucking know what's going on.
We're
Right?
working on it.
Right? We were in AC for the NBA. What was it, like 2 months ago?
March.
The NBA was
End of
When
March?
you were there on the panel.
End of March.
Was it March? Holy shit! So that was almost 4 months ago. And even then, it was like, and it was, I think it was it 4 different AMCs?
Three
AMCs. And even then, they're like, we have no idea what's going on. And I think it was supposed to actually come into effect, and then they pushed it, right? They kicked it
pushed
to
back
November.
early. Now it's going to be November, but I see a lot of people that are going to push it for starting really heavy in like
Now,
September.
yeah, exactly. So, so we'll kind of go through. So again, appraisal, some of the changes, non-QM again, because that's pretty much literally what we were all just talking about. Ways that people are getting around it, and obviously some of the strategies that are winning, right? So again, why is this important? Obviously the goal, which is like what we were just talking about, is winning more deals, right? Going through avoiding investor suspenses and underwriting surprises, right? And then building obviously stronger partnerships with your clients, with your investors, for those of us who obviously work with a lot of investors and stuff, right? So what I always say, how the process connects, think of it from a full umbrella perspective, is obviously we start off with affordability, right? Right now, interest rates are sticky, right? They're at the mid-6 perspective, sometimes low 6s if you're FHA. So affordability plays a factor, which then plays into inventory, because if rates are low, you're gonna get more inventory come on the market. If rates are sticky, you're the people who have to sell, right? The 7Ds, diamonds, divorce, downsize, diapers, all that. People are gonna put their houses on the market. Then you guys have your list price. So if affordability is obviously high, because rates are low, you're gonna have more inventory, it's gonna justify prices, which is why we see stuff throughout the country, but specifically on the East Coast, right? Home values are red hot, right? Realtors, right? And then the houses that are priced accurately are obviously being sold quickly. The houses where the seller is out of their mind is obviously sitting. And then you're seeing price cuts or you're seeing changes of real quick. And then the importance of the appraisal part, right? Which is obviously the purpose of why we're here, to see the justification behind it and obviously some of the control that it is, which is gonna eventually be able to close it. So this, again, I did a little bit more of a thorough, again, based on public data of what's out there, kind of the changes, and I'll let you guys do a little bit more of a deeper analysis on it. But from what I'm seeing it from the lens of a lender into a realtor, it's really these top 5 things, right? So the appraisal is not just getting a new look, the entire reporting structure is gonna change, right? From a 3.6 to whatever it is now. The appraisers are no longer going to be working with the old static forms, which is what we talked about. I think they're like from a single family form, and then the condo and all that is now going to change into this one dynamic form. Property details are going to be cleaner, more complete, and more accurate, which is what I was just sharing with the gentleman when we were talking about how do you add more. All right, so it's a half bath and you add, what do we say, $8,000. It's going to be a lot based off of the specs on what is out there, so you're going to have that. If the appraisal data does not match system requirements, I think what's probably going to happen in the beginning is we're going to see a lot of back and forth, right?
Oh, yeah.
Revision request, revision request, revision. And you guys are doing some already, right?
A little bit.
And then the key, I think, is for our realtors is the MLS description, the seller disclosures, the permits, the upgrades, and everything is all going to have to match. Right? And obviously, I'm sure there's going to be a sprinkle of a lot of AI probably into this stuff to pretty much either make it a lot faster or at least try to really reduce some of the back and forth of what we're seeing. We actually are even doing appraisal revision requests post-closing. I just got one the other day for a client, and I'm like, wait, this file closed, but it was a post-revision request to the appraisal for I don't even know what, but it's starting to see that. So this would obviously kind of create some of that, avoiding that. Some of the things that they're watching out for, right? Lenders have stricter appraisal data checks. So from our end, we're obviously going to have a lot more of those data checks in place. This hasn't changed since 17 years. That this more or less appraisal process has not changed. Underwriters are now going to ask more detailed questions, right, about the appraisals, even more times they do now. Appraisal revisions we just talked about. It's going to be a little bit more common as we start going through some of these changes. And then turn times, this is obviously what we don't want, but I think turn times are probably going to be slightly a little slower while we start figuring it out. And then obviously the goal is that it's faster because it's more not subjective to some of the comments. It's faster based on the specs, right? For real estate agents, again, this is eventually a good thing for us in the long term. But just like anything, right? Who remembers in COVID where we used to have to sign the COVID form and they used to have to wear all the stuff, right? Some of the changes. I think this is definitely something that's going to help clear some of the confusions or some of the conditions that we usually see. What should realtors do now differently, or referral partners, if you guys are working with investors? Prepare that property story before the appraisal is ordered. Let's be honest, sometimes appraisers, you guys may get the appraiser who maybe gives some of their homework up front. Do you take it, do you not take it, whatever the case may be, right? But again, you have some of the stories in place where maybe you get the permits done. If you do an Oprah search in advance, those are things that the appraiser can obviously appreciate. Make sure the MLS data is accurate and complete. I think that's probably what you should always do. Provide a clear list of upgrades and renovations, right? Dates, costs, permit details. Obviously, if you're a successful real estate agent, you're running that in advance to justify the sale price, probably before you go to the listing appointment. And then explain anything that may not be obvious from public records, right? Some things might have required permits, some things might have not required permits, so I think that's going to be key. So I want to blow through that real quick again. This is what we've seen from just generic information. Obviously, John and Rob will do a little bit more of a detailed analysis on that, right? Some of the stuff here that I want to talk about really quickly, because we're seeing a huge tick up. I mean, almost like 30% of our business has been non-QM this year alone, and it's been a lot of like bank statement loans. I'll be honest, we even do a lot of DSCRs, like here and there, but the reality is rates are a little steep, and being able to have it cover the mortgage, it's tough, right? Unless it's somewhat of a newer construction where you're getting pretty high market rent, right? But what I always say is these are not bad loans, right? When we talk to clients, and especially predominantly business owners, and they're in a position where they wrote off a lot of stuff on our Schedule C, right? How many of us do that, right? You write off a lot of stuff on your Schedule C because it's legitimate business expenses, right? Legitimate, and you're in a position, right? You're not screwed, right? So a lot of clients think, all right, well, how much do I have to file? Because I just filed an extension, and I have the next 4 months to file before that. You don't have to necessarily go that route. One, you're raising too many alarms, right? In terms of why did you not file that much for the prior years? But two, there's easier routes like a bank statement loan or a P&L loan and things like that, which we're going to talk about really quickly. The reason why I'm bringing this up is non-QM has been around for quite some time. It's picked up a lot of opportunity now because of rates. So just like the appraisal process is changing, I'm seeing a lot of mortgage programs start to change simultaneously as well because of this, right? So the first one, so a bank statement loans. Predominantly you're doing a 12-month bank statement. So most of us here are business owners. We have where you take your bank statements and we can go 50% off of your bank deposits with no CPA letter, right? So if you're think of it for those, who have that investor, or you have a potential consumer who's a contractor, right? And they're depositing a lot of money and it's legitimate business deposits, you can go 50% off of their deposits, no CPA involved. And then if you do have a CPA who's involved, they can actually give us a CPA letter that states that they operate at a 20% business expense. Now we can use 80% of those business deposits. Huge. That has saved us several, not even saved, that has allowed us the opportunity to get clients approved who did not know they needed to get approved, right? And they always ask, what's my rate? Doesn't matter, right? Because there's two sides to this. I get paid the same way, right? The SAVE Act allows me to get paid the same way. I don't get paid more if I give you a conventional mortgage or a bank statement loan. But what we like to do is, if you go the conventional route, the QM route, you're gonna have to pay hypothetically $50,000 back in taxes to the IRS immediately up front, whether it's a payment plan or chances are up front if you're actually looking to qualify now.
Yes. On which ones is that?
So bank statement loans. So yeah, so for example, as an example, right? Say you're looking to qualify hypothetically for a $500,000 home, right? $500,000 home mortgage payment, let's say $6,000, right? Let's work our way backwards. So $6,000, let's say you would probably need to qualify, let's say 50% debt to income, that's $12,000. You're living a good lifestyle because you're a contractor or a business owner, so maybe you have $4,000 in monthly debt. So now we gotta go 6 plus 10, double that.
Okay, makes
So
sense.
now you're at 20,000. 20,000 times 12 is 240. The average taxes, give or take, is say 25%. That's how much? 50 grand.
Okay,
Make sense?
makes sense. Sorry.
So now, no, you're good. So now, and I should have probably led it that way, but so think about it that way. And this is how we break it down in front of the consumer. Now you have $50,000 that you have to pay back to the IRS, or your monthly payment is $250 more a month. And let's do the break-even point, right? Let's say it's 5 grand more a month. Your break-even point is not going to be, or 5 grand a year. Your break-even point is in 10 years. Are you telling me this property is not going to appreciate by $50,000 in 10 years?
Hell yeah.
Can you also probably take that $50,000 in your business and 10x it, or maybe 1x it? Yes. Therefore, the interest rate should not be a conversation in these conversations.
I agree. Amen.
Right? Now, traditionally, right, real estate agents or loan officers are like, I don't know about the rate. I'll try to get you whatever I can. No, dude, you're having the wrong conversation with these particular brokers. Right? If we're all business owners, we're going to self-assess how much is this person trying to save, because chances are that business owner probably doesn't want to freaking buy the house. Their spouse is the one that really wants to buy the house, and they're perfectly comfortable to interject the money into their business. Concentrate on that, right? So DSCR, we talked about time and time again. There are like areas that are actually like blacklisted, like Baltimore. You can't get a DSCR loan. I don't know if it's loosened up, but I know for a while it's probably blacklisted because there was a lot of fraud going on. There is also certain areas, from my institution, I'm sure everywhere, urban areas, I'll leave it at that. We all know where those areas are. We have to require a QC desktop review because of a lot of the different fraud that is occurring. So a QC is a quality control desktop review, meaning that we need a independent third-party person that can't come from the same AMC, basically checking the work that the appraiser just simultaneously came up with. And it's predominantly in the urban areas where there's basement apartments, there's attic apartments, there's things along that really just from a value perspective, what they're checking, and rentals. Asset depletion has been a big one too. Asset depletion has been one that we've been doing for a lot of clients who are in a position where they're about to retire, but they have a lot of money in their 401k, or they have a lot of money in their retirement accounts, and they don't want to pull it out. They don't have to. So traditionally, if you went with a regular mortgage, Freddie Mac, conventional, say you made say you had, I'm trying to make it easier, $1 million, you divide it by 240 months, and that was the monthly income that you can add to the borrower's qualification. We have one investor that we work with. You guys work with Change a lot, right? Change Wholesale. First of all, they told me this when I was in California last month. They do 60 months. That's crazy.
That's
60 months asset depletion. Wow. So 240, 60. You're literally gonna get almost 4 times the fucking
buying power.
That's great.
I literally had her repeat it to me like 4 times. Then I saw the owner in Vegas a month ago, and I'm like, how the hell are you guys doing this? And he's explaining the math. It makes complete sense in their world. But think about that. If you have somebody who has a little bit of money, and it's usually generally consumers who are either divorced and they just got a lot of money, right, from somebody's full dispersed 401k, or a big one is if they have an opportunity where they just, which is the next one, which is a community loan. Owner occupied, 20% down, 6-month reserves, and you qualify. No DTIs, 700. So 700 and above, they'll do 20% down. 680 and above, might even be 660, but let's say 680. 680 and above, 25% down with 9 months reserves, but you qualify. That has been huge. So think about that if you guys have those opportunities with clients who may have not necessarily qualified, right, because of DTI or because of income. And it's very big. We've seen it for the clients that are getting divorced. It's generally one person was the breadwinner, the other person is not, and they're getting a home sale. Big one's been the home sale, where they're selling the home sale at the same time. and the spouse doesn't want to be renting or doesn't want to be on the streets, we've had that opportunity, and I love the feeling when the attorney calls me and they're like, holy shit, the other spouse is raging, going crazy because they have no idea how the hell they're actually getting this mortgage. You know, it's such a powerful feeling to do so. That's been a big one, along with, we just had our buddy Kevin, remember? Client, maybe in his late 70s, just sold a property, moved to Leisure Knolls, and moved there, sold one of his property, netted $180,000, bought a $400,000 house, put $150,000 down and qualified. He didn't want to touch his Social Security to tap into it early. He did not have to. Okay. 1099, obviously, so if you guys, for real estate agents, you guys all generally get 1099s, and this goes, I know they just changed the law 2 years ago where you can get it to your LLC. I know. Was it this year? So it was a year. So if you guys are not doing that to the LLCs, I highly recommend that you do, so you can now go and get paid yourself via S Corps. It's a different conversation. But 1099, we go 90% of your 1099.
Wow.
Huge, right? Again, what's the rate? Who cares?
Doesn't matter.
Cool, let's say it. Who cares? Right?
There's no one else
We've got
to do
loan
that.
officers who would say, oh, the rate's really high on a DSCR. Who cares? And then P&L is a big one too, right? We're doing one right now for our buddy. You get the CPA. The CPA basically certifies that he's reviewed it. And I just found out we will do a P&L without a CPA letter. So 20% down P&L without the bank statements verifying it, which means
That's a gamble.
yeah, let's leave it at that. That's a DSCR gamble. But you literally can get a P&L loan. Let's hope the CPA is cool. You literally have the opportunity, and it's legitimate. You can have the opportunity to get it 25% down. And again, 6-month reserves. The reserves are always going to be there. Even on a conventional loan, it's important that we let our clients know that there's always going to be reserve requirements. Reserves means remaining monthly payments in the client's bank account. It's generally 6 months or 12, depending on how many properties they have. Right? Who benefits? We talked about it, right? Self-employed, real estate investors, high net worth, so that asset depletion is huge. Unique client scenarios with assets, which we talked about, divorced consumers or consumers who are in a position where they may have fell onto some money. We just had a client, remember, who settled their personal injury case? They settled a huge personal injury case and they didn't know what to do. We did an asset depletion. So the old way I used to do it before was I used to have it go and connect them with a financial advisor and basically set up a fixed dispersed annuity. So for us, we could use a fixed dispersed annuity as long as we have proof that the first disbursement is before the first monthly payment. Because there's so many ways to architect it, just understanding how you can obviously put it together. And then of course, guys like us, right? Business partners to be able to put this together, right? What I'm seeing again, winning in this market is what we talk about. Relationships, which is why we're here on on Wednesday. Product knowledge, so understanding the products that are out there, right? We didn't talk about FHA, VA, conventional, USDA, we all know that, right? Speed and consistency, which is super critical. I mean, Santi submitted a file yesterday, right, for submission. It's already submitted to the underwriter, right? So the speed is so important to be able to get that in there. Technology, obviously, these guys are going to talk a lot on the AI and some of the tech stuff out there. I'm not going to talk about AI because we'll close the place down. And then partnerships, obviously, the relationships to be able to have direct communications with an AMC and be like, hey man, the appraiser's asking what's going on, and then our realtor's asking, and then to have that communication aspect is critical. And that's it. So, John, appreciate you guys. Thank you.
Thank you.